Trading options for consistent returns. Welcome to a TheoTrade presentation. Risk disclosure. We are not financial advisors or a broker-dealer. So the reason I throw that up there, for those of you that have never met me, I've met a lot of people over the years. I've traveled around all over the world in discussing options and options education, stocks, options, futures, you name it. My name is Don Kaufman. I'm the co-founder here at TheoTrade. And the reason I say, I'm no longer a broker-dealer, it's because I spent, the better part of my career both at thinkorswim and TD Ameritrade. So a little background on me. I started trading in the late 90s, only a few weeks out of college. I do come from a family of traders, a couple of market makers, and they owned a trading firm in Chicago. It was a natural progression right out of college. I was invited just to clerk on the trading floor, but if you put a 22-year-old kid on the trading floor, he's probably never going to leave. And I didn't. But one of the best pieces of advice that I ever got really early on in the business, and this was from one of my own family members, he said to me, he said, listen, you got to learn everything you can about what goes on here in Chicago on the trading floor, and then get off the trading floor because it's going to be gone. And that was actually all the way back in 1998 when he told me that. And I still remember it pretty vividly. So I worked in Chicago for it was about 2 years, and there was a firm that was at the time was a startup. It was a no-name firm. And it was a really odd name for him. It was called thinkorswim. And, they basically approached me and said, listen, you're a young guy. We've heard good things. Come on, come aboard. You can actually be our chief instructor and run the education group for thinkorswim. And that's what I actually did for the better part of, since, from 2000, 2001, all the way until about 2 years ago. 2 years ago, I officially left what was TD Ameritrade. I was at thinkorswim through all the acquisitions, going public, eventually being acquired by TD Ameritrade, both the good times, the bad times. Yes, I was there for the financial crisis, some wild times. So I'm fairly familiar with the thinkorswim platform. That's not essential to what we're going to be discussing tonight, but people do have questions. I'm pretty familiar with the rules and regulations of the brokerage industry. And I went on to ultimately be the lead educator for the 7 million clients of TD Ameritrade. And that was really the last 5 years prior to leaving and, of course, launching TheoTrade. So a little bit about me. I've done the whole CNBC thing. People always ask about this, but one of my favorite sayings is trading is not about being right or wrong. It's actually one of the themes tonight is trading is not about being right or wrong. But when you go up against Mr. Wonderful, well, then it's I'm right and he's most definitely wrong. This was actually a CNBC interview where I took a short position in Apple. He was the long in Apple, and somehow he defended me more than otherwise. Anyway, let's jump into the bulk of this presentation here. What you're going to learn in this presentation. So a few things I like to always distinguish right up front what we're going to talk about and be very forthright with you. So first thing, how to position your portfolio with the right logic. And we're going to talk about what trade logic is and the principles of building a trade. So that's going to be an extremely important concept, principles of building a trade. New ways of looking at and really what we call making peace with risk. Do you know what your risk is at any given moment? If the market were to fall apart, if the market were to rally huge, what's your risk? Well, we're actually going to talk about defining exactly what that risk happens to be. How to make friends with direction. I like this topic over here. And expose any directional bias and learn one thing, that direction must eventually bow to. So this is going to be an important concept. And again, that's something that's, a little bit of a leading question over there. But what's the one thing that direction eventually bows to? All right. How to use specific probabilities to better your trading, even without extensive charts or, we're not going to use any crazy formulas out there. And of course, the basic recipe of a strategy we call the in-out spread that will help you trade a little bit safer, build up some confidence over there. Whether you're a beginner, experienced trader, anyone can really follow the recipe of this trade. So that's really what we are going to be covering. And again, some leading bullet points over here. Now, before I get too deep into this, I'm going to warn you right up front. and ask you this question. Are you going to be willing to put forth some effort? Okay. The following course material that I put together for this evening's presentation can be rather demanding to learn. The course is not going to be some chart pattern. Okay, I don't get into that stuff. Or follow the bouncing ball with red and green flashing lights. I mean, people are, oh, it's a red arrow, I must sell. It's a green arrow, I got to buy it. This ain't going to be about that. If you really want to learn this business, you got to be willing to put forth some effort. All right, trading in general, this is not going to be instant coffee, instant tea. There's no piece of software that you can buy, none of that garbage. This is a skill set based on statistical data. What we're about to discuss involves trade logic, and involves strategy and probabilities in trading. And I'm very, again, forthright with you that I don't want to hear there's some, this guy has a secret formula. And please, I worked for 15 years in the brokerage industry. Okay, you think I've seen it all? Pretty much. If you look at one of the most advanced charting packages in the entire industry, okay, I was there and helped build portions of the charting package over there. So I've seen it all. And so I put over there, the bouncing ball with red and green flashing lights. This is not what you're going to get here. So I hope you guys understand. I'm a little, candid with that idea. So let's get into it. Risk and success. How you handle your risk is directly correlated to your success in the markets. Too much risk, okay? And you're going to panic and close positions continuously at the worst possible time. But hey, at least you're consistent with your panic. Now this happens to be a slide that I tend to use over and over again. And I've, not really added or subtracted anything in recent years over here, but other than the picture, because I love this, and it's a Mac actually getting sick because ultimately there's too much risk on. Nevertheless, I want you to think about this throughout tonight's presentation and really think about this regarding anything you've ever done in the market. For those of you that have never had any experience in the marketplace, you're probably like, I don't really get what you're saying. But for anyone in here, okay, and again, these are not rhetorical questions. Jump in here anytime during this presentation. For those of you that are in here, you think about this and like, have you ever panicked and closed position? And it was like, that was the bottom of the market. Right? And this can happen on a daily basis. This can actually happen on a yearly basis. This happened to people back in 2008. People tend to panic at the worst possible time. And again, risk and success are directly correlated. What I've learned. After 15 years in the brokerage industry, I have looked at hundreds of thousands of accounts. Very few people get this, but the brokerage firms study client accounts. Ultimately, I've seen what works and what doesn't. What doesn't just seems to get repeated over and over again. I always say, like, watching people trade is like watching this really bad movie. You know exactly how it's going to end, but you can't turn away. You're like, oh, this is going to be horrible. Today, we're really going to discuss what has worked consistently over time. So let's dive into the bulk of the discussion tonight. We'll start with theory, trade, and logic. When people always ask me, like, what does TheoTrade mean? It actually means theory, trade, logic. Now, we have a number of people that work with us here at TheoTrade. It's myself, Don Kaufman, Doc Severson, Tony Rago, Jeff Bierman. Jeff actually worked with me at thinkorswim TD Ameritrade for 7 years. Okay, we have, Steve Miller working with us. And many of these ideas, we come to a conclusive, and a conglomerate to ultimately present this to you. I'm not just one individual that looks at this idea of theory, trade, and logic. This is, again, a conglomerate of a number of traders. First and foremost, probabilities are law in the markets. One trade, good or bad, does not and cannot define you. Remember that. So if a trade goes against you, oh, that's okay. Trading goes beyond one trade or one idea. It's about thousands of occurrences and having the right logic over time. What that basically amounts to is you get involved in this business, never is one idea or one trade going to drastically negatively impact us. And I want you to, again, remember these pieces of logic along the way. And that's why I said this is not going to be instant coffee, instant tea. We're going to come back to this thought of number of occurrences a little bit later in tonight's presentation. Now, this is what we'll start with, principles of building a trade. If you're going to build a trade, I don't care, okay? I don't care whether the trade you're going to build is going to be an intraday trade. Think about that, intraday trade. That's somebody, okay, that's trading, I'm in, I'm out, I'm in, I'm out. I'm so in that I'm out. It could also be a longer duration trade. That's somebody that's, I put it on for like a month or two, and then there's like duration trading. And duration is, I'm in it for the long haul. One of the most important things are these 3 steps: trade logic, capital allocation, directional bias. This is the principles ultimately of building a trade. What does this mean? Like if you look at trade logic, you're like, I don't know what that means. I don't know what capital allocation is. Well, it's how much capital you're going to allocate. And directional bias. Let's go a little deeper into this. Okay, trade logic. Play strategy and trade logic first. Okay? The vast majority of people involved in markets, they're infatuated with market direction. Come on, turn on any news channel, whether it's CNBC, whether it's Bloomberg, yada, 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 Fox Business, because there's 6 people that watch Fox Business, right? Every one of them are attempting to predict the next move a stock is going to make. It's going to go up, it's going to go down. Yeah, but the right strategy, coupled with established entry and exit criteria, you don't need to be right in picking a direction in a stock or the markets in order to be profitable. So one of the things, again, you're going to see me refer back to this, trade logic is the preeminent thing you need to worry about before ever getting in. That's the point that I'm trying to make. These 3 ideals need to be followed before executing any given trade or investment for that matter. Now, on this note, okay, right or happy. So it's a pretty famous phrase over there, and my wife frequently reminds me of that famous phrase. Do you want to be right or do you want to be happy? Again, I haven't applied this to my marriage, but the logic seems to work beautifully in trading. So I'll always take the stance, you do not have to be right to make money. That is right directionally. And the reason I bring that up is, again, we're going to put trade logic first. Trade logic has a lot to do with strategy, and you're going to see me apply that tonight. The next thing, you got to have capital allocation. How and where you allocate capital should be strongly considered as a viable portion of your trading methodology. Capital allocation actually takes precedence over being right. Think about that for a second. Capital allocation is more important than being right in the markets. Why, you ask? Experience in watching order flow for decades has taught us invaluable lessons. Now think about this. Why is capital allocation so important? Have you ever been stopped out of a trade or bailed out of a position only to see the markets turn around shortly thereafter? Now, bear with me for a second here. These are not rhetorical questions. You can answer. I don't even care if you sit there and you're talking to your computer. Right? If you've done a couple of trades or you've done a couple of investments over the years, I don't care whether it's a covered call or you've gone out and just bought me some Microsoft. Yeah? And at some point you probably stopped out or bailed out of a position at the worst possible time. Again, only to see markets turn around. Oh, come on. Nobody's willing to admit that one. Of course you are. Okay? We use a phrase here often. It's called duration over direction. How and where you allocate capital can define not only losses, but it can be the defining factor in your overall success or failure in the markets. Think about that for a second. So capital allocation relates directly to duration over direction. Can you hold a position long enough? You know how you can hold a position longer? If you're allocated a little bit less. Our war cry around here is duration over direction, which means you need to be capable of sustaining trades long enough to be profitable. And the only way to do that, of course, is with a comfortable allocation. Last but definitely not least, directional bias. So again, we're thinking about these different elements before ever entering into a trade, right? What is it? Trade logic, which is about strategy. Capital allocation, which is clearly how much you're going to allocate, because it's going to be the big defining factor over there. And third is going to be directional bias. Now, I don't want to come off as an anti-charts. I'm not an anti-chartite. Okay? I made that phrase up. An anti-chartite. Rather, we recognize where you think a stock might go does not mean the markets will agree with your sentiments. Oh, I'm so bullish. Yeah, the market doesn't always agree with that. I'm so bearish. It definitely doesn't agree with that. Being right directionally cannot define us as investors or traders, for we might not be right often enough. Okay? And people talk about getting stopped out over here. Let's get to it, right? So again, we started off just on the, the peripherals of trading here, talking about trade logic, talking about capital allocation, talking about duration, okay, over direction, and more importantly, direction itself. Now we're going to start to bridge our way into core strategy and trade logic. This is going to be one of the most important concepts that we're going to go into tonight, which is core strategy and trade logic. What does that really mean? Today, I want to introduce you to what we call like one real world strategy that you can effectively start using tomorrow. And again, I like this, the just say no to risk. I'll start as we bridge our way into the core strategy and trade logic. I'll start with this idea of risk versus reward. Now, here's where I'm going to be, again, very forthright with you. Things that get a little dicey from here on out. This is where, hey, you can understand some of the previous slides, but now we're going to get a little bit more hardcore. Risk versus reward. When we first learn about markets and trading, we're often exposed to the ideas of risk versus reward. Like everybody's heard that. Risk 1 to be able to make 2. It's a common strategic entrance to the marketplace. Okay? Hey, listen. However, have you ever looked at the probability of success of this idea? So number one, those of you, again, they're not rhetorical questions. Have you ever heard that? Risk 1 to be able to make 2, right? Isn't it about the most common thing that people hear? Again, 15 years in the brokerage industry. And again, I traded on the professional side for a few years. I was in the brokerage industry. In the brokerage industry, I still traded. For the first many years of thinkorswim, we that worked at thinkorswim were we were the largest clients of thinkorswim. Just a couple of former traders that started a brokerage firm. And we used to constantly see this, like risk 1 to be able to make 2, risk 1 to make 2. All right? And people hear it all the time. You go into all this stuff and like, oh, that's the way we're going to trade. But seriously, have you looked at the probability of success of this idea? I know that sounds like, kind of again, like what's it leading into me? Probability of success of the idea of risking 1 to be able to make 2. It's such a simple idea. Okay? It's such a simple idea. Debunking risk versus reward. Let's take a look, okay, at the following example. Buy a stock, let's say at $30. So I'm going to take you through this idea over here. So we're just going to go out, we're going to buy the stock at $30. We're going to set a stop order close, okay, at 29. And we're going to set a target price of 32. So for the most part, what does it do? This, okay, is the buy. You set the stop order, stop, okay, and then a target price. That's my, my out. This is the prototypical risk 1 to be able to make 2 scenario. Now, there's a lot of different risk 1 to make 2, right? I could have risk 2 to be able to make 4, yada, yada, yada. I just wanted to make this easy. That's the scenario. You just bought the stock, set the stop order $1 lower, set the target price $2 higher. Timeout, okay? Probabilities in your trading. What I want you to think about right now, okay? What is more likely? Getting stopped out at $29 or making the $2 profit? What do you think is the probability of hitting the stop order prior to hitting the target price? This is such a simple idea that we seem to surpass. And it's just a simple idea okay, first and foremost, in this idea, forget that you know which direction the market. Forget that you know which direction the market's going to go. Put the direction of the market, all right, in the hands of the market. Let's say the market direction is a 50-50 chance, because I know that everybody wants to come here tonight and they're like, are you going to show me a pattern that's going to tell me which way the markets are going to go? No, right now I'm going to tell you it's a 50-50 shot. So if the market's a 50-50 shot, okay, what has a higher probability of occurring? The stock dipping down to 29 or the stock, for instance, going up to 32? Okay, there's a substantially higher probability the stock goes down 1 before up 2 in a normal volatility fluctuation. But everybody gets convinced, no, I know which way the markets are going to go. Did you know you can actually define the probabilities of this entire setup? You can actually define probability in this setup. Watch. Okay? Options are probabilities. Now, you may have never looked at or even traded an options market. However, are you aware that options are based on probabilities? Now, I said the O word. I know. Don't get intimidated by options, but options, they can help us in determining the viability and practicality of any given trading strategy. You pretty much name it, whether it's stocks, whether it's options, whether it's futures. Okay? The options market is defining probabilities. How, you might ask? Well, let us look at what the probabilities, okay, are in the aforementioned risk 1 to make 2 trading setup. And let's see if it's viable over the duration. Now, this is one that's going to start to fly a little bit. You ready? Probabilities exposed. Okay, there's a lot going on this slide. Deep breaths. Okay, very deep breaths. First and foremost, the stock that we happen to be looking at on this slide is Starbucks. There it is, it's Starbucks. I took and retook the screenshot today. Starbucks is trading at $57. I used this really simple concept and I thought, what if I buy Starbucks at $57? And I looked at the probability of hitting, it's actually called the probability of touching, okay, the 56 level. Why 56? Because if you buy the stock at 57, losing $1 would be what? Well, 56. And then I looked and I said, well, if I put my target at $59, now listen to me, we have no intention in this trade of trading the options, but I'm using the options, okay, to ultimately determine the viability of the strategy. And people constantly ask after they see this example, they go, how come nobody ever touched this stuff? Okay, this is stuff that's been around, okay, since the 1970s. I mean, literally since like the late 70s, people have been using probability to define a viability for strategies. So if I buy the stock at 57, I want to know the probability of hitting. I call the probability of hitting, it's the probability of touching, the probability of hitting 56 versus the probability of hitting 59. Why 59? Because that leaves me what? $2 to the upside. So risk $1 to be able to make 2. Risk $1 to be able to make 2. Okay? Look at the probability of touching 56. It's what? Basically a 68% chance of happening. What's the probability of hitting, or what we call probability of touching, 59? Well, that's about a 39%. I'm rounding, right? It's about a 39% chance. Okay. Deep breaths over here. Ready? So, risk versus reward revealed. In the aforementioned Starbucks example, S-Bucks, right? Probability of hitting the stop price of 56 was 68%. You have a 68% chance of getting stopped out. Time out. You have a 68% chance of getting stopped out. Why do you think there's a toilet bowl with flushing money down? And the probability of hitting the target price was 39%. The risk 1 to make 2 scenario is a low probability disaster. Okay? And again, I like to debunk strategies out there because everybody goes, I'm going to go out and I'm going to risk 1 to be able to make 2. Yeah? Well, you have almost a 70% chance of getting stopped out. Conversely, you have about almost a 40% chance of hitting your target price. Now, if you hit your target price, you make a little bit more money. But the probability of you getting stopped out, my guess is in the retail world, you are likely and very likely to, ultimately lose a lot of money really, really quickly, get disillusioned, and then not do that strategy anymore. Make sense? All right, how many people have ever done that one? Come on, people admitting it's the first step. It's a very, very quiet group. Well, maybe you guys are quiet because you're just sitting there yelling at the computer screens. Now, I have to keep stressing this stuff as we go along. This is devastating. And we can take you through umpteen different examples with this, okay? Where, again, when you start looking at trade, and this is Starbucks right here, right now. You can look at this stuff 10 days out. Okay, you can look at the stuff 24 days out. You name a stock, and I can show you the exact same example. You know, people bring up stocks like Twitter out there. It's a $16 stock. All right, what's been in play lately? For instance, something like Bank of America. Is this gonna be true in Bank of America? Of course, you better believe it. You better believe it. Look at the probability of touching the 22 level. Right? That's only 60 cents away. 68% chance of it happening. Versus, for instance, hitting the 24 level, which has a 34% probability. We can go to umpteen different examples. It doesn't matter what marketplace. Markets are all the same, right? Probability is probability. Bank of America is going to be no different than Twitter, is going to be no different than Starbucks. But the probability of getting stopped out is going to be drastically higher than hitting your target price in every case when you do a risk 1 to be able to make 2 scenario. Okay, that's why I just brought up a live trading application. Now, positioning your portfolio with the right logic. So put everything we just talked about behind us. Again, we have to expose some of the flaws in trading before we do what we kind of call it, like, let's get down and dirty. How do you position yourself most effectively without exposing yourself to drastic risks and or a low probability? Okay. Would you be interested in a trading strategy that, well, number one, overcomes the high probability of being stopped out? All right, think about this. We're going to be looking at a trading strategy that overcomes the high probability of being stopped out. Number two, defines your risk. I mean, everybody wants to be able to define their risk. Number three, provides a high probability of success. Not only aren't we going to have a high probability of getting stopped out, we're actually going to have a relatively high probability of success. It's all relative. Number four, limited capital exposure. So again, I'm being a little repetitive over here. Not only does it define my risk, but it limits my capital exposure. You're going to know precisely what the capital exposure happens to be. The reason I relisted that is because you're not going to have to do what? Never need to buy or sell the stock. Okay? All five of these is going to be encompassed inside of one very straightforward piece of trade logic, and that's enter the in-out spread. In-out spreads are designed to limit exposure and maximize potential with minimal movement in an underlying. That's an important concept again, because, earlier I started off with you don't have to be wonderful picking direction. You do have to have a wonderful piece of trade logic. You do have to have really strong capital allocation, but minimal movement in the underlying. So we're going to limit exposure, right? Maximize potential with minimal movement in the underlying. In-out spreads are options trades. Fear not the options. Again, I said the O word. Is option spreads allow us to limit our risks without the use of stop orders, okay? Meanwhile, providing considerable upside potential. So I like it. Somebody said, bring it on. Yeah, bring on the options. So this is going to be an age-old strategy with some very wild twists that we've added. And this took us a long time. So in-out spreads explained. Now, I'm going to use, all right, and kind of hand write this in over here. This is a marketplace. Now, let's define the marketplace, okay? Now, this can be a stock. It can be any stock that you want it to be. Let's just use a very simple example. Over here's a stock. And let's say this stock is trading at, for instance, $100. So if the stock's trading at $100, now a stock can obviously rally up, the stock can sell off, do a little dance, right? What I'm doing though with this is what they call a distribution curve, right? It's a distribution curve. And the reason I like to use a distribution curve is I don't want to put any emphasis this evening on being right or wrong. In fact, quite the opposite. I want you to view the marketplace just for this evening, just bear with me, as a 50-50 shot, okay? The reason I want you to view it as a 50-50 shot it'll make the examples tonight easier because I don't want to put interference in your head. I'm not going to tell you tonight, I know which way the markets are going to go. No, but I am going to tell you we're going to have an effective strategy, okay, regardless per se of the direction of the marketplace. We're going to put yourself in a better trade logic with a better probability, okay, and a better stance overall in the markets. So assume that you got a 50-50 shot. Fair enough. That's why I put a distribution curve in here. Now, we're going to go out and we're actually going to use an options strategy. And again, this is a stock, and I'll blank this slide 10 different times over here. This is a stock, and it's trading right at $100. We're going to use, okay, a tactic called the in-out spread. So if the stock is trading right here at 100, we'll give you an example. We're going to go out, all right, and we're going to buy, in this case, what's termed a 99 call. We're going to buy a 99 call. Now, a 99 call, listen, some of you that are joining us, okay, have never had experience with options, and that's okay, right? It is absolutely fine. If you've never had any experience whatsoever with options, you buy a 99 call. What does the 99 call give you the right to do? It gives you the right to buy the stock at 99. What did that 99 call cost? Listen, this thing, it could have cost as much as I'll give you an example, $4. Like that thing could have cost $4. That's expensive, right? $4 is what you paid for the 99 call, but the 99 call gives you the right to buy the stock at what? 99. The stock's trading at 100. Okay? So here's the stock at 100. You have the right to buy the stock at what? 99. It's a 99 call. But paying $4 for it, so we're simultaneously going to turn around and sell, okay, in this case, the 101 call. Now, a 101 call. What does that give you the right to do? It doesn't give you a right. It gives you an obligation. You have the right to buy the stock at 99. Now you're obligated to deliver somebody else the stock at 101. Oh, how much am I going to collect for this thing? Remember, when you buy something, you pay a debit. Okay? When you sell something, you collect, all right, a credit. In this case, we're going to collect, we'll call it $3. Am I making the math easy enough? We buy something for $4, we sell something for $3. What do we net out? Well, how does this thing really net out? You buy the 99 call, you sell the 101 call. Net, you buy this, you pay $4. Okay? You sell this, you collect $3. What does it ultimately cost you? $1. Debit. Okay? And time out over there. Don't worry about what you're going to make. Okay? Don't worry about it just yet. We're going to show you all the ins and outs of this particular trade. There's a lot going on, though, right now on the slide, and I want you to understand the risks inherently involved. If you buy the 99 call, you have the right to buy the stock at 99. If you sell the 101 call, somebody has the right to take stock from you at 101. Okay? Be careful, though. You don't own the stock. You never had anything to do with the stock. You don't ever have to own the stock. You don't ever... I mean, people go, well, what happens if somebody says I have to give them the stock at 101? That's okay. What happens if the stock goes to 150? You have to sell stock at 101. You're obligated to sell stock at 101. Yeah, but if the stock goes to 150, you have to give somebody the stock at 101. But you have the right to do what? Buy it at 99. What would you make? What would you make in this spread? If you have the right to buy something at 99, okay, but then you're forced to give the stock up, all right, at 101. What's the most you could possibly make? $2. What'd you pay for the spread? $1. What's the most you can lose? Whatever you paid for the spread, which is $1. In this particular scenario, okay, we pay $1. We can make $2, but we paid $1 up front. So really the most we can make is $1. Now, stop right there for a second, because there's always questions that come up about this. You're like, whoa. You're risking $1 to be able to make $1. Risk 1 to be able to make 1. And you go, I don't like it. Because if I'm right, I make $1. But if I'm wrong, I lose $1. But we haven't talked about probability yet. Because in this particular case, I'm going to show you how the probability of making a dollar is substantially higher than the probability of losing the dollar. You see, probabilities, okay, are separate from risk reward. It's what we call probability of profitability. Probability of profitability. So here we have a scenario where you're like risking a buck to be able to make a buck. You're like, I don't like it. Again, there's a lot going on in this slide. All I want you to understand is the very simple concept, all right, of what an in-out spread happens to be. And at this point, all we've done is we buy the 99 call, okay, and we sell the 101 call. If you get that much, you're going to be okay. And that this particular strategy here happens to be bullish. Now, can this be done bearish? Absolutely, without hesitation. In fact, I will show you a number of bearish trades as we continue on this evening. If you understand, we're buying the 99 call and selling a 101 call. You know, a lot of people ask me, why do we call it an in-out spread? Because the stock is trading at 100. One of the options is what we term in the money. The other option is what we term out of the money. If one is in the money, the other one's out of the money, that's why it's called an in-out spread. Huh? Now we're having fun. Now at this point, bear with me. We're gonna start dig into real strategies now. So I just wanted to, outline, if you will, concept. Now we're going to start to bridge our way into, well, real strategy. So in-out spreads, Starbucks example. S-Bucks is Starbucks. Let's continue with our Starbucks example. Okay, now, hang on just a second. Just a few minutes ago, we were looking at a Starbucks example. What was the Starbucks example? Well, we were buying Starbucks at 57. Okay, we were setting a stop at 56, setting a target price at 59, yada, yada, yada. We found out that the probability of getting stopped out is drastically higher than the probability of hitting our target price, and that we found that it was actually easier just to take the money and flush it directly down the toilet bowl rather than to do this stop order, risk one to be able to make two. Got it? We wanted to position ourselves high probability of being, we just have to overcome the high probability of being stopped out. We want to be able to define our risk, have a high probability of success, limit capital exposure, and never actually trade the stock. Well, the in-out spread is going to give us all of that. Again, rather than buying the stock at 57, we will use a spread trade to limit risks and provide a high probability without the use of stops. Frappuccino. I had to put that in there. It looks really good. Don't worry, there's only like 700 calories in that. And 300 milligrams of caffeine. It's good. It's good for you. This is a Starbucks in-out spread. Now, I'm kind of laying it out just like I laid out the previous example that I totally, just destroyed the screen over there. But for the most part, here's how the trade will actually lay out. The stock, Starbucks, is trading at 57. Okay? We're going to buy a 56 call. And that 56 call, let's say, is trading for $1.50 debit. So you're going to pay $1.50 for it, right? Then we're going to turn around and we're going to sell the 58 call for a 50-cent credit. Now I've labeled it down here. We buy one, okay? We sell the other. We buy one, we sell the other. If you buy one for $1.50, sell another for 50 cents, it's a $1 debit. Now, what's the most you can lose on a dollar debit? If you pay $1 for something, you go out there, you buy something for $1. What's the most you can lose? $1. That's it. It's the most you could possibly lose. If the stock trades to a big fat 0, you can lose $1. If the stock trades to 500, what's the most you can make? Well, you have the right to buy the stock at 56. Somebody has the right to take stock from you at 58, but the most you can possibly make is $2. But you paid $1 up front for this trade. So what's the most you can make? $1 on the trade. But here's the kind of the cool part. We're getting there. We're getting there. Right? You can risk $1 to be able to make $1. Risk $1 to make $1. Think about this. Risk, all right? Risk one to make one. Risk one to make one. Risk one to make one. You're like, I don't know if I like it. I'm going to show you why you're going to like it. You ready? Okay. Let's actually take it to a live trading application. Now this happens to be the thinkorswim application. Now I know we have a lot of people, okay, that are watching this. They're joining us from all over the world. Not everybody has access to thinkorswim, nor do you need it. It's just what I was comfortable with putting the trade example together on. You might be on umpteen different brokerage firms. This is thinkorswim. You could be on Interactive Brokers. You could be at Fidelity. You could be at Charles Schwab. I don't care. It's all okay. It's all okay. What I want you to see in this spread, and I really want to resonate with you, all right? We're going to get into probabilities a little bit here. First and foremost, Starbucks was trading right at around 57 when I took this screenshot. That's the Starbucks price, okay? I went out and I buy this 56 call. This is calls. Everything on this side of the screen over here, these are my calls, okay? I'm buying a 56 call, and I'm simultaneously selling the 58 call. Buy one, sell the other one. Now, this is what we call a vertical spread, but it's tweaked a little bit. It's an in-out spread, and the whole trade is done for a $1 debit, which once again, I mean, listen, this is the price you see on the screen. It's done for a $1 debit. Now, this happens to be, okay, a bullish trade. But remember earlier we talked about trade logic, right? We talked about trade logic, we talked about capital allocation, and then we talked about direction. Again, like the most least important thing over here, it's a bullish trade. Why is it okay? Why is it okay to risk a buck, okay, to ultimately make a buck? Why is it okay? Well, if you look at what's called probability of the touch. Now, not every trading application has that, and it doesn't matter because there's ways to do probability of touching without ever having to have that calculation. You don't need no stinking calculation over there. You set the trades up right, and I know I can show you how to set up these trades correctly. The probability of touching, okay, is not critical, but for the example, it's important. I want you to see how high the probability, all right, of hitting. I like to call it probability of hitting. I want you to see how high the probability of hitting the 58 level happens to be. It's a 65% probability of hitting the 58 level. And people always ask, well, why is it okay to risk a buck to be able to make a buck? Because the probability of hitting these levels is extraordinarily high. Again, look at the probability of hitting 58.5, even the probability of hitting 59. There's no stop order needed in here. Why is there no stop needed? Because you only have $1 at risk. Part of the logic of this entire trade is a very simple, but it's not completely evident by looking at this. And I want to make it more evident to you that when I say this, I'm like, well, what do you mean part of the logic? Part of the logic of the trade is a very simple idea. You have a 65% chance of hitting this like target level of 58. That's okay between now and 24 days from now. This is the number of days left till expiration. There's a 65% chance of that happening. Okay? Now, part of the idea of the trade is something that we talked about earlier, and it was called duration over direction. What is duration? You got to hold the trade long enough. Well, you can hold this trade for a pretty long time, at least 24 days. But if you want, you could do this trade for even longer. I'll come to that in just a moment. You could do this trade for 24 days. You could do it for 35 days. You could do the trade 2 months from now. Now, one of the things that people always tell you is if you buy options further out in time, it's going to cost you more what? More money. That's not true with in-out spreads. Come back to that in a moment. One of the key pieces of logic here is this, okay? Duration over direction. Duration over direction means this. I have to hit my target price. I want to make a buck before I lose the buck. And the probability of me making the buck is really good. It's like a 65% chance. The probability of me losing the dollar, it's a real probability. Guess what? People, Ain't no guarantees in trading. You could lose the dollar. But the probability of hitting the target price is much higher than the probability of losing the buck. This is a game, all right, of probabilities. And I also talked about earlier in this presentation the number of occurrences. I can't tell you that every trade is going to be right. I can't tell you that your directional bias is good. Moreover, I don't even care. I am telling you that if you're right half the time, and how could you be right half the time? I don't know, flip a coin, be right half the time. The probability of hitting, all right, and making the dollar is higher than the probability of losing the full dollar. That's the key. How come I don't lose a full dollar? Because I never get stopped out. Yet, when I hit my viable target price, then I actually exit the trade. So think about this, right? You can only lose $1. Even if the Starbucks goes to $50, you can only lose $1. You go, oh no. What happens if the stock goes down? So what if it goes down? You're going to lose $1. What happens if the stock goes up? Well, if the stock goes up, you're going to be profitable. You're going to make $1. And there's a much higher probability of that occurring. Why? Because you don't get stopped out. It allows you duration over direction. Speaking of duration over direction, here, check this out. I don't know why I have Bank of America up here. Let's go back over to Starbucks. Now, Starbucks, I took a screenshot today, but listen, we can go further out in time. I got a 24-day trade. That's the one I did earlier, right? What did I do earlier? I did the 56, for instance, 58 spread. Huh? Trading for about $1. But could I go further out in time? Let's take this exact same trade. It's trading for right around $1. All right? Let's take this exact same trade and not do the January 20th. Why not go out to February 17th? Well, apparently that's not traded. Why don't I go out to February 3rd? Oh, look, it's trading for 1 penny more. Why don't we go out to March 17th? Oh, apparently those strikes are not traded. Okay? All I want you to see is just because you go further out in time, the trade does not necessarily cost you more. Just because you go further out in time, the trade does not necessarily cost you more. You know, we were looking a moment ago at Bank of America. Could be a viable example. How could you build a trade in Bank of America? Could I go 24 days out? Yes. Now you have to know how to set this trade up. You know, Bank of America, listen, that's an easy one. Somebody already typed in over here, let's go look at Amazon. Why? Because Amazon's a $770 behemoth, right? It's a $700, almost $800 product. So don't let that intimidate you. Just go out and use a spread, okay? Look, here's a $2.50 wide cent spread for $1.33. I'm not saying this is the perfect trade, but I just want you to see that you can trade almost an $800 stock with $133 at risk. Now, somebody always asks about commissions. Don't you worry about commissions, okay? We have a number of different deals at brokerage firms. Why? As I spent 15 years in the brokerage business, everybody wants to do business with TheoTrade. So they give us a couple of great deals. Now, this one's done for January 20th, but again, I could go further out in time. I can go out to February, look at this, February 3rd, right? These are the real numbers on the screen right now. This is a live market. This is 38 days. The 38-day trade, it actually costs me less. It's only $1.25. Okay? I can go even further out. It's February 17th. Apparently those are not traded. March 17th. Those ones are not traded. Not every strike is traded. It's fair enough. But I wanted you to see, just because you go further out in time doesn't necessarily make it a more expensive trade. That's why I say duration over direction. Okay? And you start looking at the probabilities of this stuff. It's like there's like a 96% chance of hitting some of these levels in here. Overwhelming. This is a lot to go through tonight. Now, yes, this is a trade in Starbucks. Can you do a bearish trade? Oh yeah. By the way, I like bearish trades. I'll show you in a moment. I really like bearish trades. All right, you just use them with the puts. Buy an in-out spread with the puts. Okay? I can show you 1,000 different bearish trades. And any given day, there are umpteen different in-out spreads. Sure, there's more advantageous times. Sorry, it's between Christmas and New Year's. That's not going to be the most liquid market in the world. But, right, it doesn't necessarily matter. You know, and coming into like July, and it's like the July 4th weekend out there, and it's kind of slow trade, you can still find good trades. All right? It doesn't matter. What I'm saying is like time, date, okay? Just because there's like a holiday trade, as long as the market's open, there's effective trade available in that marketplace. Here's another example. This is one that I put together on GLD. Why did I do it on GLD? I don't know. It was gold. Gold? It's been the talk of the town since I've been in this industry for almost 20 years. I've gold this and gold that. But gold, GLD, it's a lot of risk out there. It's about a $108 product. It's a $108 product. Why not go out and just buy, in this particular example, just buy the 107, sell the 109s. Limit your risk to $1. You don't need a stop order. The probability of hitting, the 109 level is as high as almost 81%. And again, I can go through example after example. People always ask about, does volatility affect this? No. This trade offsets volatility exposure. This trade offsets many of the risks, that people are exposed to. Again, I'll go back to a live market, and this is live market condition. Obviously, the market is not open at the present. Nevertheless, here's GLD. It moved from when I took, the original screenshot, but that's okay. I can go even 52 days out. Why? I need more time. I need more time to be right. You either need more time to be right or need more time to be wrong. You decide. But if I wanted to get bullish on this little monkey, I could do the 108 in this case. All right. I could even do a 108, 109. That's a $1 wide spread. Look at this. A $1 wide spread. 52-cent debit. Do you realize if you do one contract of that trade, it's only going to cost you $50? Now that's where people, commissions can impact me. Again, don't worry so much about commissions. This industry is changing. Don't worry so much about commissions. We can help you with that. Don't worry so much about, people ask, can I do this in an IRA? Of course you can do it in an IRA. Tax deferred accounts, fine, do them. There's spreads. And again, this happens to be a bullish trade. Why not do the bearish trade? Could I do a bearish trade? Yes, you could do a bearish trade. Here's a bearish trade. It's with puts. Maybe you want to get bearish on gold. Don't let my own directional bias influence you. Now, we've talked about different durations. We've talked a lot about probability. We've talked about probability of hitting in here. The maximum risk sustained is $1. Doing this in tax-deferred accounts. Let's show you a couple of live in-out trade examples. This is a fun one. Now, what you are currently looking at on your screen, are trades. These are not paper trades. This is from a live account. This is the opening. This is the closing. The opening and closing of the position. These are the exact strikes I used. This over here on the far left-hand side of the screen is the exact time of entry. Just so we're all clear, I happen to be on Mountain Time. I'm in Scottsdale. We don't change our clock. So if the times look a little weird too, the market isn't open at 8:12. Yes, the market is open at 8:12. So here's a trade that I put on, and I call this the election spread. It's a VIX trade. I went out there and just bought an in-out spread. I only paid 65 cents for the little monkey. Hey, listen. All right. I was able to sell it for $1.05 credit. But it's only a few days later. And if you're curious, what was the market doing at the time? Hey, listen, you can go look at that, go back and, again, look at what the market was doing at these particular times. That was a trade that I entered right here on October 25th. Now, did I know that the volatility was going to go up? Absolutely not. I just figured there's an election coming. Election is coming and the volatility is sitting at 13. It's a buy. So I bought volatility, and then the irony of the entire thing was I got nervous, and look at the closing date. I closed it before the election. Why? Because the volatility went up before the election. It's kind of I would almost call that one a little bit of a layup. And I got out of it. I ducked out early because I was like, I'm a little nervous. Show you another example. These are in-out examples in Google. Now, there's a multitude of examples in here. I like to trade the same underlyings again and again. I don't know if you guys do that, but I do, right? Here's one I entered on May 11th and exited on June 14th, It looks like in this Google spread, I opened it. This is a put spread, so this trade is most definitely bearish, all right? This one over here is a bear. The one down below, because it has puts, is a bear, And the last one on the screen is also puts. Told you, I like to do the same thing again and again. Right, is also a bearish trade. Now, Not all 3 of these trades made money, but I do want to show you. Here's the opening of the trade on May 11th, the closing of the trade on June 14th. Okay? It's a bearish trade. I opened it for $2.39. It's a $5 wide spread. I closed it, okay, for a $3.70 credit. Got it? Here's one that I opened, a bearish trade, for $2.33. I sold this one for a $3.60 credit. Here, this is a losing trade. I went out there and I purchased the spread for a $1.10 debit. Now look, this one, it's only a $2.50 wide spread. It differs from the $5 wide spreads. This one I paid a $1.10 for. Ooh, I closed it for a 35-cent credit. I lost money on it. And I like to show both winning and losing trades. Okay, here's the fun thing. Each of these 3 trades were bearish. Okay, they started in May, ended in October. Now, why am I going through that? Because go look at Google. Go look at Google and what Google has done from May, okay, ultimately to October. The point that I'm trying to make with this, Google in May, all right, was all the way down here at like the 700 level. It did nothing but rally from then to October. Each of the trades I did was bearish, okay? Well, how was my directional bias? It was terrible. It was terrible because somebody just asked, a moment ago, oh, how did you determine whether it was bullish and bearish? That's something I can show you. However, in this case, I want to be very specific and explicit. I was wrong. And yet 2 out of the 3 strategies played out. Why? Because I had what we term duration over direction. Keep telling you, the strategy, the capital allocation, and the trade logic, they're much more important than being right or wrong. Right? The strategy is way more important because I was able to sustain the trade. Look at this. This is a June 17 trade. I don't know. Between, May and June, the stock went up. But I had a bearish trade on it, still made money. Here's Amazon. I did 2 different trades in Amazon. These are just 2 trades I'm happy to show you in this particular case, but it's similar to the Google trade. I like to trade Amazon. I like to trade Google. Okay, I like to trade the VIX a little bit. I do trade a lot of the index products like the SPX and the spiders. Okay, again, I go back to the well. I constantly trade the same products again and again and again and again. Why? Doesn't matter. It works. If you told me I could trade one product for the rest of my life, I'd probably still be fine. It would be a little bit boring, but doesn't matter. Here's Amazon. At the time, this is a bearish trade. This is a bearish trade. Why do I like bearish trades? Well, that's something I can show you here, but bear with me. This one was actually entered into on June 6th, exited on June 24th. Sorry, crossing out on June 24th. I entered the trade, okay, for $1.21, got out for $1.92. Now, this is a small profit, but it's still a profit. It's still a profit on here because this one, I was up against the clock. Clock was ticking on that trade. Again, duration over direction. But eventually it pulled the strategy out. Hey, making money beats losing money. In this trade down below, here's one that was actually entered in once again. September 28th, exited almost a month later. Okay, and it was profitable. Again, debit of $2.30. Credit of $3.45, both bearish trades. Why I'm showing you this, again, the reason I like to show the live trades is, what did Amazon do from June to October? June to October. Let's go to the chart. Here's Google. Let's go look at Amazon. Help if I actually put in the right symbol. Let's go look at Amazon. Amazon, here's in June to October. It rallied. Both of those trades were bearish. June to October. Look exactly at the dates, though, the trades were placed. Look exactly at the dates. June 6th to June 24th. Okay? You can't make this stuff up over here. June 6th, which happens to be right in this neighborhood over here to the 24th. Look, the stock dipped just enough for me to make. I just want to zoom in for a second. You don't have to have windfall profitability. You don't have to be right by a lot. You just have to be right a little bit. That was a bearish strategy, okay, when the stock was rallying overall. But we hit the profitability point and got the hell out. The exact same thing happened into September, October timeframe. Do you realize pretty much from right here to right here, the stock started selling off and it just hit our profitability point. Very minimal movements with very minimal risk is a very good way to trade, and being wrong on direction, okay, You can be wrong on direction. All you have to do is be right for one day. One day. It's the right strategy, the right trade logic. And I constantly harp on that stuff. Here are some of the characteristics of in-out spreads. Okay? The attributes of the high probability in-out spreads, they're undeniable. Okay? You never have to buy a stock. You define your risk. Risk is limited to precisely your comfort level. The reason I say risk is limited, well, you're defining your risk, but I further want to mention your risk is limited to precisely your comfort level. Ultimately, why? Because you can select how many contracts you want to do. I could tailor this. Look, here's a $1 wide, $2 wide spread for a dollar debit. If I wanted $1,000 at risk, I'd do 10 contracts. If I wanted $500 at risk, I'd do 5 contracts. That's not that bad, is it? Precisely your comfort level. You don't need to use a stop order. Why? Because I know what my risk is. Right. You can vary time frames and not pay more. I showed that. Instead of going from January 20th, we could bump it out a couple of weeks, few months. Okay. Probability of profit is high. We saw the probability of hitting the target price. This is the perfect spread to reduce risk of a stock portfolio. This is also an excellent tool for those seeking returns to build a smaller account. You got to build from somewhere. Whether you have a large account, a small account, it's inconsequential. But it's important to understand these concepts. Building the in-out spread. I know there's a lot of stuff we've gone over tonight, but hey, breathe deeply. Do not let options intimidate you. The spread below, it's being done for a $1 debit. However, the spread is also akin to a massive chainsaw. Used correctly can be extremely effective in creating returns. Used incorrectly, well, just like a massive chainsaw, I'd probably lop off a couple of fingers, possibly an arm over there. Fear not. The in-out spread. You may not know options or have limited experience in placing option trades. We can show you how and when to place an in-out spread in a matter of a few hours. What we do here at TheoTrade is create detailed recipes for every strategy, including, of course, the in-out spread. You wouldn't go out and you wouldn't bake a cake without a recipe, so why trade without one? And that's the way we look at trading is, it's a checklist to be able to get in and then out of a trade. And people always ask, well, why doesn't everybody do this? Well, here's what you need to know. As I said earlier in the presentation tonight, this is not instant coffee, instant tea. You need to know, what stocks do I do this on? Obviously, I showed you Starbucks, I showed you, Amazon, I showed you Google, even the VIX. How do you determine if you're bullish or bearish? Yeah, that came up a couple of times, right? What expiration do I select? Do I go at a month, a week? When you start to look at trades these days, seriously, when you start to look at trading, what expiration do you select? Go in here and take a look at something like the SPX. Just bear with me for a second. Go look at the SPX. Okay? In the SPX, there's 1-day options and 3-day and 7-day and 8-day and 10-day and 13-day and 15-day and 17-day and 21-day and 22-day and 23-day. Look at this. There's expirations every single day pretty much. There are literally 3 expirations a week now in the SPX. You have to determine exactly what expiration you're going to go into. Exactly what expiration. What strikes do you use? $5 wide, $2 wide. What position size? What's the correct probability for the trade? How do I execute the trade? When do I exit? What do I do with a losing position? And on and on. That's why everybody doesn't do this stuff. That's what we do here. Criteria. It's what we do at TheoTrade. Trading, it's about answering all of the what ifs. What might be a good stock or ETF candidate? Again, correct options expiration, capital allocation, strike price, options that you buy or sell, answering the what ifs. It's all of the what ifs, though. You can't just answer one or two. Every variable has to be covered. Again, the probability for the trade, the option contracts, when do you close the trade? What if the stock sells off big? What's the correct return for the strategy? By the way, absolutely, without a doubt, one of the most consequential steps of criteria is the correct return for the strategy. If the stock rallies massively, can I fix a losing trade? I get that question all the time. Well, TheoTrade has your answers. We have the answer to all of these trade-related questions regarding this in-out spread. We build recipes with definitive criteria and checklists for each strategy and each unique variable you will encounter. It's the how, it's the when, it's the why, at what price. It's just the beginning of all the variables you're going to face while buying in and out spread. Speaking of which, we're buying in and out spread. People always ask, why aren't you selling a spread? In some cases, we do sell spreads. But the secret, well, is in the sauce. Now everybody thinks to themselves, you can read about these spreads anywhere and can do this. Well, first and foremost, think again. And number two, of course you can read about spreads. You can hop on Google right now. There'll be no less than 10,000 different sites that'll tell you what a vertical spread is. But they're not going to tell you, right, the checklist, the criteria. The following strategy and corresponding criteria requires the utmost attention to detail. We spent months, fine-tuning this trade setup. By the way, we're on to years now. Literally years have gone into fine-tuning the trade setup and criteria. When we approach the selection of criteria, follow the steps to build the trade. Okay? Would you like the criteria to build an in-out spread? Well, we have a class. It's high probability in-out spreads course. I happen to be the instructor for this one. Now, here at TheoTrade, again, we have a number of instructors. It's myself, Tony Rago, Slim Miller, Doc Severson, Jeff Bierman. Okay, all of us compile detailed criteria that go into these courses like the in-out spread. And somebody asked about direction. Okay, for most of the directional bias, I defer to one of the great, market technicians, which is Jeff Bierman, Doc Severson, Slim Miller. In this particular class, it has entry and exit criteria checklists available immediately for download. You can go and you can grab the class. It's available immediately with unlimited access. And download it tonight. The class, it's $97. The web address is theotrade.com/spread. And I'm going to show you, there's a lot more than just this in-out spread course. Now, as an additional bonus, we do options 201. That's vertical and calendar essentials. Now, before diving head on into the in-out spread class, now many of you may have some options experience. If you have some options experience, go and start watching the class tonight. Literally, start watching the class tonight. Class is available immediately. Start watching the class right here, right now. It's unlimited access. I don't care. Watch the class 500 times. But you can also download all the entry and exit criteria checklists. It's in a PDF format. It's a slide deck. It's a PDF format. And it literally has checklists. Step 1, Step 2, Step 3. As a bonus, again, we have the options 201, vertical and calendar essentials. This is just understanding everything there is to know about verticals and calendars. It's the essential building blocks before diving into the high probability in-out spread course. In addition to it, we also threw into this pack what we call volatility essentials. The reason volatility essentials is really about probability. Now, the reason we call it volatility essentials, the word probability scares everybody, but options 301 is a huge amount about volatility and probability. All three of these classes, the 201, the 301, and the high probability in-out spread course, it's all $97. Why do we do this? Ultimately, to get people into the correct trade logic, using the right criteria for entry and exit. Now, let me go through with you a little bit of the course curriculum. So, again, go to theotrade.com/spread. The in-out spread curriculum. Number 1, you're obviously going to learn to construct in-out spreads. In-out spreads, they're used daily by professionals. This is a trade that's used for consistent returns. How to buy long duration options without paying more. And that's really giving yourself the gift of time. That's duration over direction. How to use defined risk reward strategies so you don't lose sleep over the positions. Again, you're not going to use a stop order, right? Learn how to use this in really any market condition, no matter how volatile, or lack thereof the market gets. Right now, we're in a lack of volatility. Last year, and the year before that, we've seen wild volatility out there. Nevertheless, not a huge amount of volatility maybe in the present. The future holds possibly unlimited volatility. Again, it'll work in anything. You got to learn to build your own with detailed step-by-step entry and exit criteria. A lot of people are like, feed me trades, or build your own trades. I'm telling you, the criteria, I still follow the steps. The These spreads are also easily managed with what we call set and forget order types. You can use what's termed a GTC order. That's a good till canceled. You do not have to sit and watch markets all day long with these strategies. I like to say that again. You don't have to sit there. You can use GTC. Some people actually work for a living. If you have mobile access, fantastic. But if you're working for a living, you just set GTC. Okay? In-out spreads are easy to learn, okay, and really easy to execute. They can be done with a trading account. Got to have $2,000 in the account, but the trades can be done in retirement accounts, minimal options experience, and be done in smaller accounts looking for larger upside potential. Now, take you to the web address. Again, you have to type into your browser TheoTrade.com/spread. As you do, this page will actually populate. Okay? This is, of course, a little bit more about the in-out spreads, what's included in the class. Again, there is not just the in-out spreads class, but the options 201, the options 301. I feel pretty strongly about the options 301. I'm going to tell you right now, Volatility Essentials. Those are some sessions, okay, you will thoroughly enjoy. And as you're going along tonight, if you have questions, you want to talk to us over here, okay, there's no problem. Here's all of our information. So TheoTrade.com/spread. There's the number 800-256-8876. Support at TheoTrade.com. Now, I'm going to go in here and I'm going to be answering a few questions. I've already gone through most of the curriculum. I just want to clarify again, it is 3 courses. It's $97. And we do this because, again, we're building better clientele for the brokerage industry. And again, it is me that did the entire in-out spread class. You can go and start, watching it tonight, download all of the materials immediately from that. So, all right, a few questions that I want to get, because there's a lot of questions that are actually fired in over here. So I'll kind of read them pretty much in order. All right, first and foremost, question for Mitch. I never could get my head wrapped around options. Will I be able to follow along in the class? Well, first of all, if you have not seen the Options 101 class, we do have an Options 101 class. If you've not seen the Options 101 class, we can send you a discounted link. So please email support@theotrade.com. But I'll argue this. If you understand the absolute basics of options, just jump into the 201 class. It'll give you everything you need to understand, okay? Everything you need to understand moving forward into the in-out spreads class. Really, the vertical essentials portion of this, and this is a multiple part series. Again, this Options 201 is a multiple part series, okay? I think you guys will really not only enjoy it, but it'll give you insight to the marketplace maybe you've never had before. And even if you understand options, I'm telling you, sometimes going back to the foundation and the building blocks, that's why we give you the Options 201 and the Options 301. By the way, I'll tell you right now, I don't care if you've been experienced, you've been trading for 10 years plus. The Options 301 will still rock your world. I love talking about volatility and probability. So, Mitch, hopefully that helps you out. All right. Next one. Susan. I've lost a lot of money trading. Found it hard to pull the trigger. Will the class help? So when people talk about that phrase, I like that phrase, pull the trigger. Pull the trigger, okay, references executing trades. One of the things that you have to be comfortable doing is executing the trade. Our criteria will literally walk you into each and every trade. When I say there's step-by-step, criteria and the checklist, okay, the checklist actually walks you right into the execution of the trade. It checks to make sure that you've actually constructed the trade right. Now, the other portion of that question is, I've lost money trading and I found it hard to pull the trigger. If you've lost money trading, first and foremost, listen, there's no guarantees with any class. You still have to be able to follow a checklist. There's some pilots out there, and pilots have checklists as they hop into an aircraft. Okay, does it assure they're not going to crash and burn? Absolutely not. Okay, the checklist provides the right materials, okay, and the highest probabilities of success out there. And that's, again, I like to confront that where I say, yes, here at TheoTrade, listen, I'm in the brokerage industry for 15 years. I don't give guarantees, but I will tell you, okay, you really want to learn this business, you will love this class. And this particular class, the in-out spread, pretty much put like heart, soul, and a huge amount of research into that criteria over there. All right, next question comes from Perry. I don't have much time to trade. I work full time. Will I be able to do this? So we already kind of referenced this, but I'll again describe. Yes, okay. There's such thing called a GTC order. It's a good till canceled. You can execute in and out of the trade using good till canceled. Most of the research, right, and really the trade setup can be done at night with no problem. These spreads are slow moving animals. Okay, this is not like I'm in, I'm out, I'm so in them out. If you saw my trades, there was like 3 weeks to a month. Again, you saw some of my trades. There were 3 weeks to a month between the entry and the exit of some of these trades. I don't want you to have to be a hyperactive individual that's like, I'm in them out, I'm so in them out. Okay, just be aware of that. So the GTC orders are great. Again, it stands for good till canceled. All right, next one. Rich, I can't get approved for options because I'm a newbie. Will your class help me get approved? Okay, first of all, to get approved is easy. People tell me this all the time. To get approved is easy to trade options. Spreads trading. First of all, I spent 15 years in the brokerage industry. I can help you get approved for options. Now, all right, not every single brokerage firm is going to allow you to do anything you want. So I'll make some strong, recommendations to you as to, number one, where to go in the brokerage industry to get approved. Number two, can you do this in an IRA? Of course you can. All right. So do not worry about getting approved in the account. They always say at the brokerage firms, you need experience. Well, guess what? TheoTrade is your experience. And again, we'll pull a couple of strings for you in the industry. Next question. Tom, I swing trade stocks. How's this class going to help me? That's probably like my favorite question we've gotten so far. You swing trade stocks. My gosh, Tom. You know, the idea of like swing trading over here is pretty passe. First of all, why go out there and buy the stock at all? You know how much capital you're going to tie up? You know, when people talk about swing trading stocks, that's going out there and like buying a stock, praying it moves up or down in a given time frame and hoping not to get killed. But what happens to people swing trading stocks, they can be right 80-90% of the time. Seriously, I've seen people that swing trade stocks. They'll be right 89-90% of the time and they'll still lose money because it only takes one devastating loss. That's it. Could you imagine, if you went out there and you bought some stock and all of a sudden, I'm swing trading it, baby. I'm swing trading it, and news comes out and the stock drops by 50%. If you've been a swing trader, listen to me. You've had that happen. You have had that happen. If you've been a swing trader, don't let it happen again. Use spreads because spreads are going to mitigate your risk. The stock could get cut by 50%. You're going to take a small little bump on the head and be like, oh man, it's a good thing I didn't buy the stock, Tom. You will love us. If you are a swing trader and you trade stocks, how's the class going to help you? Okay, it's going to save your life in a lot of different ways. All right, moving on over there. I don't want to go too much into the swing trading because, again, I despise the idea right now of holding stock and be like, I'm in, I'm out. Yeah, you could think of in-out spreads as swing trading without having the risk of holding some, behemoth stock out there. Every stock is a behemoth. You can look at even Facebook over there. It's 118 until earnings comes out, and then it's like a $50 stock. You don't know, okay? Or God forbid you get in something like Tesla. Oof. All right, next question. Mike, I have a 6-figure retirement account. I need income to pay bills. Social Security doesn't cut it. Can I trade these strategies in a retirement account? All right. Yeah, absolutely. You can trade them in a retirement account. So IRAs, okay. Ultimately, again, not every brokerage firm allows you per se to trade inside of the retirement account. I'll actually direct you. Sure, TD Ameritrade does allow complex spreads. Complex being in and out spread. It does allow spreads inside of the IRA. No problem. And if you like the idea, monthly income, that's what these spreads are designed for. All right. Okay. I've got a question for one or two of these over there. And yeah, so people are asking a couple other questions about covered calls and so forth. So, with covered calls, you could do covered calls, but these spreads are taking a step forward. So somebody said, like, my brokerage firm limits me to doing covered calls. Well, George, get a different brokerage firm. You need to be able to do what you want with your money. Do what you want with your money. And if one brokerage firm won't let you, okay, either number one, I'll twist the broker's arm, or number two, we'll move you to a brokerage firm that'll let you do it. And again, I just cannot stress this stuff enough, okay? Somebody else came in here, and Rick actually said, I've spent thousands at other educators for the privilege of following their trades into the toilet. I like that one. The privilege of following other people's trades into the toilet. Okay? How can I be sure the same thing won't happen at TheoTrade? First of all, again, I spent a long time as a registered rep in the brokerage industry, 15 years as a registered rep. And I will tell you right now, there's no guarantees in trading. I think that's probably the second or third time I've said that. Okay? You're not going to spend thousands of dollars, all right, here. All right, listen, this class is $97, okay? Undoubtedly will give you all of the tools to give you the highest probability of success in the marketplace. Again, does it guarantee you make money? No, okay? But we're going to give you, all right, multiple steps in the right direction. And, the one thing I will guarantee you, I will help you, okay, in email support in any way, shape, or form to understand these types of spreads. I mean, that's the best guarantee you can possibly get. Listen, after watching people trade for 15 years, I know why people lose money. I know why people make money. I don't want to see people lose money. The best thing we could do for you is give you the right steps, the right criteria for being able to get in and out of these trades. So please join me. Check out the high probability trading with in-out spreads. Again, it's TheoTrade.com/spread. Feel free, give us a call, support at TheoTrade.com. Goes to all of our representatives here at TheoTrade. I want to thank everybody for joining us tonight. Okay, ran over a little bit on time, but it's worthwhile. I want you guys to feel strong about this strategy. Again, see you here at the high probability trading with in-out spreads class. Have a great night, everybody. Bye-bye.